All right. So, hey, Michael and Deborah. I'm Ryan Reynolds. I'm the medical field underwriter. It's been assigned to you to go over the mortgage protection info today. I'm kind of like a national broker, so it allows me to shop all the A-rated carriers for you nationwide. There's about 65 companies we look at. So, companies you've heard of: Mutual of Omaha, Transamerica, Aetna, Aflac, etc. List goes on. I'll spend probably about 3 minutes on some medical questions. And then based off your age and health, that's going to let me know what you guys can qualify for at the lowest cost. Is that making sense?
Okay.
Okay.
Question, when we set up our mortgage, it was supposed to include mortgage insurance.
Yeah. So that's kind of a confusing thing that some people do kind of get mixed up, but there's homeowners insurance, right? And this protects the bank in case there's in case there's a fire. What's that?
I'm aware of that, but our mortgage was supposed to include mortgage insurance as well.
How does that insurance work from your definition?
I don't know. I was told that mortgage insurance was part of our quote.
Okay. Huh.
Now,
Oh, there might be. Oh, there's another one that's required if you don't have 20% equity in the house. And
okay,
yeah, I forget what's that one called? P something. It's not mortgage insurance.
PHFA.
What's that?
I don't know. We're with PHFA.
Okay. Yeah, there was that kind of insurance that they required people to have after the 2008 housing crisis. And what happened was people were getting loans for 300,000, and then the loan dropped, the value of the house dropped to 200,000, right? And then they defaulted, and then the banks couldn't, they were trying to foreclose, they couldn't get their money back, right? So this new insurance that they require you to have is if you default in your loan, it covers the bank for that loss they took on the foreclosure. So that you have to keep it on there until you have at least 20% equity, and then you can take that insurance off. But that protects the bank. Okay. The
Okay.
Yeah, this type of insurance is voluntary. It's a very popular product if you can qualify for it, but it protects you guys. So it's called mortgage protection. And what it's designed to do is if there's a death, by you, Michael, or you, Deborah, it pays the loan off. So you guys don't have any loan anymore. It protects you guys because there'd be a loss of income. Also, if you got sick, cancer, heart attack, stroke, couldn't work anymore, it's going to pay off the loan. Or a lot of times people add on disability, and it pays the mortgage payments if you can't go to work from like an illness or an injury for 2 years till you get back on your feet, so you don't have the risk of losing the house to the bank. So that's what this is. The first two that the bank requires, that protects them, because obviously if there's a fire, they want the house rebuilt, so in case you default your loan, they could take the house back, right? But in this circumstance, let's just say, Deborah, you lost your job, right? And then the house got foreclosed on because you couldn't afford the mortgage payment. The bank just takes the house back and they sell it and get their money back. Okay. But you guys can lose equity that way. Okay. So this is more protection for you guys versus the bank. Does that make sense?
Okay.
Okay. So like I do see your loans at 170 right now. What's the house appraised at?
Shit, I don't even know.
Okay. Did you guys just move in or?
Yeah.
Oh, nice. Well, congrats on the house. So let's just say, you just bought it for 170. Maybe there's not too much equity in it yet. But let's just fast forward 15 years. Let's just say you paid that house down to 100,000. Okay. And let's just say the value of your house goes up to 250. Very likely scenario. So if you sold it for 250 in 15 years, you paid off your loan of 100,000, you have 150,000 left over. Is that making sense?
Right.
Yeah. So you have a growing asset going from 0 to 150. Now, do you guys have any cars in place right now? Do you drive some cars?
Yeah.
Okay. You guys probably have car insurance too, right?
Yeah.
Okay. Well, see, that protects an asset like most Americans have it. I mean, I have it on my car, but that protects an asset that goes down in value versus up in value. So, most people want to protect their houses because they're assets that increase in value. And for most Americans, it's their biggest investment they have. Is that making sense?
Yeah. I mean, but like what are we looking at price wise average? Just,
Well, once I get the medical questions out of the way, we'll shop all 65 of those carriers, and it will let me know what you can qualify for. And then as far as price goes, you guys decide on that. So I give you all the different plans, options, and we keep customizing it for you and your budget. So,
okay.
but we'll get you the
So
exact
if
cost.
I'm making now, did you like send us the quotes in an email or?
No, we'll get you it exactly right now. So you'll write it down on a piece of paper, the plans, and then we kind of keep customizing it for you.
Oh,
Yeah, so we shop all 63 companies: Mutual of Omaha, Trans, America, Aflac, Aetna, American Amicable, the list goes on. So we look at all of them at once and just see what you guys qualify for at the lowest cost. But, everyone picks different plans and everyone has different budgets. So it just kind of depends on you guys.
Yeah, well, I can tell you right now, ours is like extremely tight.
Okay. Well, what I'll do is just start with the absolute lowest cost plan and we'll see if it makes sense. Okay. Is that fair?
Yeah.
Okay. And then I don't have to ask any medical questions on this one, so I'll be pretty quick appointment. But I do have Michael here. What was your age right now?
50.
50. Okay. And then Deborah, what was your current age?
38.
38. Okay. And then Michael, what do you do for work?
Maintenance.
Maintenance. Okay. And how much do you bring in for the year typically?
Oh God. I have no clue.
Well, what do you think your best guess is? Like 20, 30, 40, 50, 60, 70?
I don't know. I don't know. I have 20.
Maybe like 20. Okay. So about 20K.
I think the smallest is 400. What? Might be 6.
Well, I mean, how about if we break it down monthly? What do you think you bring in a month?
That's what I was trying to do.
Oh, gotcha.
Trying to figure that out here quick.
Okay. Yeah, take your time.
Save only 2,000. Okay.
Around 2,000.
About 2000. Okay. So we're close to about 24, give or take. And then Deborah, what about for yourself? What do you do for work?
I'm on workers' comp right now.
Workers' comp. Okay. And then how much income does that bring in right now?
Like 1,300.
About 1,300 a month. Okay. So adding that up, we're, about 15,000, give or take. Okay. So obviously, income's a little bit tight, right? If something happened to you, Deborah, yesterday, God forbid, it was a car accident, heart attack, and that extra 1,300 stopped coming in, Michael, bills are going to be a lot tighter for you, right?
Yeah.
Okay. And situations reversed, something happened to Michael yesterday and wasn't here today, Deborah, you probably wouldn't be able to afford to stay in the house at all, correct?
Mm-hmm.
Okay. So let's see if we can find a plan that maybe we can squeeze out a couple dollars to protect your biggest asset, because, you guys pay on your car insurance, but your car's not going to be worth 150,000 in 15 years, unless you got a classic Ferrari or something, right? Does that make sense?
Yeah.
Okay. So all the plans I'll go over with you today, and we'll kind of keep customizing them. They're not something you can buy. You do have to be approved for them. Okay. So if you do see a need for it, like most people do, my job's pretty simple. It's just to help you guys put in a request for approval. And then the insurance company gives us an answer in about 3 to 7 days if you're accepted. Okay. If you do get approved, they give you 30 days to adjust your policy. So as we start kind of giving you a couple plans, if you're not really sure which one you want, just know we have 30 days to adjust it up or down, or even decide we do not want protection altogether. Does that make sense?
Yep.
Okay. Now, if you don't want a policy, just let me know. We'll close the case out. We don't do second appointments since we're in the shop every carrier nationwide, and we won't even know if you can get it until we apply. Did you have any questions on that?
No,
Okay. And then for that approval process, the insurance company will require 3 things. I don't need these now, only when we pick the right plan out for you, but they will ask for these 3 things. So I want to make sure you have them on you. They'll ask for a driver's license for background check, a social for a prescription check, and then a routing and account number to pay for the policy if approved. They do not take debit cards because they're not secure. Routing account numbers are because they've been handed out on checks for the last 60 years to strangers. You can't buy anything with those numbers. Okay. Does that make sense?
maybe.
Okay. Well, let me get you that cheapest option first, since we're trying to keep in a budget. And then if you do like it, what would happen is I'd help you apply, and then we would have, every year I would do an annual review with you guys, be assigned to you, and we can always upgrade it later if we want more coverage. Okay.
All right.
Let's see what we got here. Because we just never know what tomorrow might bring, and hey, it's always going to help you guys out to have that house completely paid off here. Okay, so we got age 50. We got state for you, Pennsylvania. And that's male 50. You guys are both married, right?
Yep.
Okay. So it saves you some money if you guys are married. You guys can both be on the same policy. And I'll do 170,000. Okay. All right. So cheapest plan I got, it's 170,000. It's an accidental policy. Okay. So it's the 3rd leading cause of death is an accident. So think car crashes, stuff you see in the news, stuff from an injury. Okay. Shot, car crash, choked on food, hiking, storms, accidents. So 170 grand pays out. It stays at 170,000. So even if you owe 100,000 on the house, you get the full 170, house pays off, and you keep the extra 70. Does that make sense?
Yeah,
All right.
Okay. This one lasts till age 80. Okay. And it covers both of you for $35.17.
and that's monthly.
That's monthly. Yep. That's kind of the lowest one we go. Now, a lot of times on these ones, people do get extra just because you always keep the extra money. It does go up to $500,000. So if you want to see what a little extra is, we can always, price that out as well. We can go lower than that, but I wouldn't go lower than what your mortgage is, because the whole point is to have that loan paid off. Okay.
Right.
So go ahead and ask me some questions on this one, and we can keep adjusting it how you guys see fit.
Well, I mean, that would be something that would probably end up coming out of my budget.
Okay. Well, I mean,
Um,
the other type you could look into later would be like full coverage. So it would cover you from like natural cause death, like a heart attack, cancer, but you could always keep this one while you're kind of getting your budget back together, because you're on the workers' comp right now. And then we can always try to upgrade it like a year from now. Okay. Or whenever. You guys will have my number in your cell phone when we're done, and just give me a call whenever you want to look into upgrading it. Now, those ones are a little more expensive, obviously, but this one's going to be your most budget friendly one.
right.
You want to maybe see let's see what a 200 is, just for the heck of it. I don't know. Sometimes it's not that much more. A 200K, I give you an extra 30K, pay off the car too, 200,000 for both of you is $40.
Gotcha.
Okay, so we can do the 170 for 35. We got extra 30 grand for 200,000 for 40.
Gotcha. And I have to make a decision by when?
We're applying for it today, and then we'll find out 3 to 7 days if you're approved.
Okay.
And then if you want to make any changes to it, you have 30 days to make changes to it.
Okay.
Okay.
All right. I guess go ahead and do the application and we'll see what happens.
Okay. Do you want to do the 170 or the 35?
Yeah, the 170.
170. Okay. And then on this plan, the way it works, because the whole point of this is getting you guys protected. If it gets approved, it typically takes about 3 to 7 days for it to go get approved. They'll withdraw the premium so you're covered. The policy takes 2 weeks to get out delivered to your house. Once you get that policy is when your 30 days starts. And then if you don't want it, they'll return that $35 to you. If you want to raise coverage, you can. It goes all up to $500,000. Does that make sense? So you think you guys will be able to afford it in 3 days and be covered?
Right.
Yeah, we'll find out before that if you're approved, but I just want to give you a heads up. We'll call you and go, hey, you got approved, but does that make sense?
Yep.
Okay, perfect. All right.